Welcome to the Balance Sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. Purpose is not a word people associate with finance, but today's guest thinks that it should, and that the world of finance has forgotten its purpose at great cost to the world. David Pitt-Watson is a leading thinker and practitioner in the field of responsible investment. He's a fellow here at CJBS, where he co-teaches an elective that won the Financial Times Responsible Business Award for teaching. He's written several books arguing that the study of finance requires that we explicitly address the purpose of the industry. David is a practitioner. He was co-founder and CEO of Hermes Focus Funds and Equity Ownership Service, the largest responsible investment group of any institutional fund manager in the world. He's also served as independent non-executive at KPMG, treasurer of Oxfam, and has chaired UN Environmental Finance Initiative. So, welcome, David.
Hi, Conrad. Nice to be with you.
So, David, could you start by reminding us what are the main functions of the finance industry?
Yeah, well, I think it's really worth our spending time thinking about them. If you were to say, what would I say were the headlines? I think, look, one, it's got to keep our money safe. Two, it helps us transact, doesn't it? You go with your credit card and you can buy stuff. Three, it allows us to share risks. So, life insurance, for example, and if I die young, then my dependents are looked after. And then I think the most critical service, I think the technical word for it would be intermediation, but it's taking money from the real world where it is and taking it to another part of the real world where it's needed. So I would have those four functions. And then the finance industry, unlike any other industry, is given amazing power to be able to carry out those tasks because the finance industry owns the equity in companies. And with that equity comes very considerable power, for example, to appoint the board of directors.
And David, what are some of the main players in the finance industry? And I think you've got this slide here to illustrate
Yeah,
that.
why don't we show the slide, Conrad? Yeah, I mean,
Yeah.
this kind of looks at the intermediation. On the one side, you've got savers, and you've got people who are in some way trying to make sure that they can share risks, and they give their money to insurance companies, to fund managers, to banks. There's then a great big trading system that exists between the banks and the fund managers and the insurance companies. And then you have typically companies, but also people individually who need to borrow, who are the investors who use that money. And we're all very familiar with, you have a bank account or you have a loan or you issue equity or you trade derivatives or you do whatever else you do, the various different securities that are traded between those various different institutions. And by the way, loads and loads of other institutions as well, from brokers to stock exchanges to all sorts.
Okay. And obviously, this is a really nice, simple chart. Is this too simplistic? I mean, where are the hedge funds or the
Really,
private equity firms, the MBS, CDS,
uh,
securitization,
uh,
all
uh,
those financial innovations that we
absolutely,
teach?
absolutely, Conrad. And so, I put some money in my pension fund, which then decides that it's going to give it to our hedge fund, that then decides that it's going to buy a derivative security, that needs to buy that security, a derivative from an investment bank that itself has been to an insurance company to make sure that the derivative is going to be safe, and so on and so forth. So vast numbers of transactions. But what are they all trying to achieve? In the end of the day, I think they're all trying to achieve those four purposes. In particular, the purpose of taking money from point A where it is to point B where it's needed. And the trading of those derivatives, the the trading of shares on the stock market, for example, are to help companies raise money so that I can put my money into them and they can then invest. And if I need to get my money out again, I can do that by selling the shares on the stock market. So if we look at this through the lens of purpose, it's just quite a different perspective, I think, from the one that says finance, let's start with a net present value calculation, where you go down a sort of technical route. This is a practical route. What's it there to do? What can we learn about how well it does its job?
Yeah. Of course, we've lived through quite a few of these financial crises. There was a global financial crisis in 2008, and then smaller crises throughout the world. Now, I think this chart is what most people conceptually have in mind what the finance industry is. But these crises that hit us were a result of all these fancy financial instruments and innovations. Do you think that the finance industry has become too complicated?
But I think there's a really good argument that it has, Conrad. But I want to be careful about what I say here, because I don't think we need to be throwing babies out with the bathwater. But I think it's really, for anyone who is serious about understanding the industry that they're working in, the finance industry, I think it isn't enough to know how the standard techniques work. I mean, there are many people who would say one of the reasons for the global financial crisis was the use and abuse of some of the techniques of risk management and risk mitigation that we are teaching in business schools. I think that there's some truth in that.
So what should we be teaching in business schools?
I think we should start by questioning ourselves about what is the purpose. I've offered 4, but I'm really happy to debate that with people. And I hope there are some people already that are listening to this and saying, no, all that other trading is really valuable. And let's wait. I think so. First of all, I think we should spend some time thinking about that. I think we can come back to some of the evidence of this as well, Conrad. We should question how well the finance industry is doing its job and look at the evidence that we've got on that. I think as well, I'm all in favor of you do need to understand how a present value is done and what a tracking error is and Gaussian statistics and all the rest of it. But if you look at the factors that have made financial systems really successful, it's rarely that somebody has done a cleverer net present value calculation. And I can maybe come back to that. I think as well, the financial system is given that massive power, isn't it, because of equity holding and influence on the corporations of the world. I mean, it's the heart of capitalism, and we live in a capitalist society. So if we want to influence how it is that companies behave, there is the finance system there. So there's all those other perspectives, other disciplines, psychology, anthropology, institutional economics, as well as neoclassical economics, behavioral systems, all of those go into what makes a successful finance system, not just being able to compare the value of 2 bonds with a net present value calculation.
Okay. I'm relieved to hear that there is some grounds for teaching technical stuff in the business school, because we charge quite a bit of money. So
no, this is absolutely right. I use this example in one of the classes. I remember I graduated from Stanford 40 years ago, and I remember one of my first jobs, I was a consultant, and the investment bank for the company that I was working with refused to do a net present value calculation of an acquisition that the company was looking at, because they said that a net present value calculation was spuriously accurate on the values that it gave. It's quite interesting. I have to say the company then hired me to do a net present value calculation, but it is quite intriguing that, within admittedly quite a gray-haired person's lifetime, there could have been serious people in the finance industry who were saying, no, these techniques are all nerdy and they won't help us very much.
Right. And a reminder to the audience, if you have any, I'm not sure if it's a comment or a question from Jeremy, who um, is here in Cambridge. I'm trying to put him up here. Yeah. So Jeremy, I'm not sure what you're getting at, but Jeremy, it's taken us only 10 minutes for someone to talk about crypto. And I noticed Bitcoin is trending again on Twitter. That means it's broken yet another ceiling. So
Yeah.
Jeremy says crypto is now a few trillion US dollar market cap. So Jeremy, if you have a question, feel free to put that on further on. But David, you,
Crypto is
sorry, you.
it's such a good question, though, isn't it? Tell me, what is the purpose of cryptocurrencies? I'd be, I might have that as the exam question this year. I do quite struggle with it. I have to say.
So we'll keep that question in mind. But Jeremy, sorry, David, you also talk about how rapidly the finance industry has grown, but has it become efficient in
Yeah,
that time?
so this is one of the challenges that I have that class consider. Maybe look at slide 2, Conrad. But this shows the finance industry as a proportion of the GDP. I think from about 1880 up to the present day, and it's gone from about 2% of the GDP up to about 8% of the GDP. This is in the States, but you would discover it in other countries as well. It also looks at the amount of money that has been intermediated from the real world to the real world. And that has gone from about 1 times GDP to about 4 times GDP. So 2% of the GDP to 8, 1 to 4. And there's a rather intriguing professor, he's called Thomas Philippon, he's at New York University, says, look, if you divide one of those by the other, you can work out how much it's cost to intermediate $1, yeah, from the real economy back to $1 back in the real economy again. And therefore, you can work out the productivity of the finance industry in intermediation. And if you go to just the next slide, I find this very challenging. That line's pretty flat for 120 years. The green line, by the way, is one that is just the base data, and then the orange one is where he's adjusted for smaller bank accounts and so on and so forth. And that just seems amazing, because during that period, we've invented computers and telephones and all sorts of things that should have meant that the cost of intermediation had dramatically fallen, and it hasn't. It feels like there's lots of activity that's taking place, but it's not so clear how that activity is delivering on its purpose.
David, this is quite counterintuitive because I'm old enough to remember having to write a check or cashing in a check and taking it, it took me days to get the money in my bank account, right? And I had to go to a bank branch, right? But nowadays I get money pretty much instantaneously. So wouldn't the cost have gone down? Why has it been so constant?
You see, I think in transaction processing, they almost certainly have gone down, Conrad. I don't have the numbers for it. Although not all transaction processing, if you look, for example, at the margin that somebody takes when they exchange your foreign currency at an airport, I have some tables from 1900, and 1900 actually looks like there were narrower margins. But anyway, not everywhere. But transaction costs, I think, must absolutely have fallen. But that overall measure of money from the real world invested back in the real world looks like it stayed flat. One of the things, though, talking about transaction costs, is the number of transactions that it takes to get that money from point A where it is to point B where it's needed has multiplied. So if you say that the balance sheet of the entire financial system is about 4 times the GDP, the Philippon numbers, and then you say, but if I add up all the institutions within the financial system, how much bigger is their balance sheet than the balance sheet between the real world and the real world? If I'm remembering correctly, it's about 5 or 6 times. So there's lots of stuff where the financial system is trading with itself. Now, that trading with itself is difficult to justify in terms of the purpose of serving the outside world, unless you're getting better investments, less risk, more intermediation. And some of it is leading indeed to less risk and more intermediation, but maybe some of it isn't. Maybe some of it is just a zero-sum game that costs a lot. And
Okay, that's
And if we're
so.
going to be good financiers, we need to just be aware of this, yeah, because we need to know that what we're doing is helping the patient. A bit like sometime in the 19th century, doctors decided that they weren't going to, in the West, they would always remove blood from you if you were ill. They've been doing it since for 2,000 years. And somebody started to ask questions, this removing blood from people, is it actually curing them? In the same way, I think as professionals in the financial system, we need to step back and be able to ask ourselves, are these activities delivering on purpose? And don't we want them to be delivering on purpose? Because, boy, if we're going to solve the big problems of the world, climate, poverty, inequality, prosperity, old age, all of those sorts of things, we desperately need the financial system, desperately need it.
We have a couple of questions. I think this first one is from someone in Sydney about crypto, where it says, well, some people believe it. Let me reframe that and say, David, what's the problem with crypto? Isn't it a willing buyer, willing seller? People are, someone's buying it at a value they think is fair.
Yeah, everything's willing buyer, willing seller, isn't it? Throughout the finance industry. We all learn that where there is a willing buyer and a willing seller, then markets have got to be efficient and welfare maximizing. Except, of course, if there are situations of asymmetric information where the buyer knows more than the seller or the seller knows more than the buyer. And therefore, they can encourage people to do things that are not in their best interest. One of the games we play in the class is to see whether one half of the class can will not missell, but whether they will sell in a way that is to their advantage, that can't be seen by the other half of the class, despite the fact that ultimately they can. So look, crypto is willing buyer, willing seller, isn't it? I think. Whether it's willing knowledgeable buyer and willing knowledgeable seller, I'm not sure. I think crypto, it does perform a function. It's difficult to think about it being very good as a currency because its value goes up and down and up and down and up and down. But it might be fun to bet on cryptocurrency, so it can do the sort of the Las Vegas thing. The other thing is, of course, it allows you to transfer very considerable sums of money anonymously, just like cash. So who is it that would be helped by being able to transfer large sums of money anonymously? Well, I can, certain people are not necessarily involved in a activity that is admirable or indeed is legal because they want to be able to hide that. What would otherwise happen to the money that is invested in crypto for transactions? Presumably it would be invested in cash, and therefore it would go to governments who would spend it on what governments spend things on. So I'm not saying crypto is wrong. I'm just saying let's ask ourselves questions about what is it that is there for. You can probably hear in the way I'm speaking that I'm not a huge fan of crypto. But if you want to take crypto bets, of course, that's up to you. But you should recognize that any crypto bet is going to be a zero-sum game minus the costs of crypto, and therefore, on average, will lose.
Yeah, and for those people interested on a crash course in terms of asymmetric information, mis-selling, I encourage you to watch the movie The Big Short. which is a very entertaining walk through some of the seedier corridors of finance.
And here's the thing. What I'd say in all of this, I think it's two things, Conrad. I've devoted my life to the finance industry. I can't see how we have a sustainable, admirable, prosperous world unless we've got the finance industry working well and working right. And the net present value calculations are all very well, but they're not really asking that big question about what does it mean for the finance industry to be working well and working right. What should it be doing about environmental issues, for example? What should it be doing about poverty? How do you get money to poor people? Because net present value doesn't help you an awful lot with that. So how do we do those? And I'd simply be saying, look, if you're going to be a professional in business where you're responding to the finance industry, and more particularly, if you're going to work in the finance industry itself, you want to challenge yourself with these questions, because they are the very big questions that hit you when you end up as a leader in the finance industry.
We've got a question from Howard, who's an alum, an MBA alum, and he works in investments, actually. It's a very simple question for you, David. Can you discuss the purpose of finance, covering ownerships, facilitating business, protections, risk management, macro, flow of assets?
Yeah. So I had four, of which all four are critical to the facilitation of business and to protection and risk management. But just having a place where you can keep your money safe is profoundly important. Any of you who might be interested in I worked for Oxfam for a little while for the UN, and I was on a commission with the governor of the Bank of Bangladesh. I said, "What's the thing you're most proud of as your job, Bank of Bangladesh?" And he said, "Oh, it's a thing called the 10 taka account, because in Bangladesh I passed a law that if you wanted a license to be a bank, anyone with 10 pence could open a bank account, because then the money would be safe, and also it allowed me to transact with poor farmers." And he said, "I knew I'd done something that was a bit special when I discovered that street kids in Dhaka were coming into banks and opening bank accounts. Because if you're a street kid and you earn any money, you'll be robbed." So just basic things. First basic thing, can keep your money safe. Second thing, transactions processing. Again, if I can use a sort of development world example, M-Pesa in Kenya, absolutely transformational, uses mobile phones to give people bank accounts so that itinerant workers can send money back to their families. Absolutely extraordinary, taken many people out of poverty as a result. All of the insurance industry, and by the way, lots of the investment industry, facilitates business, facilitates individual risk management, and most critically, getting money from where it is to where it is that it's needed, which, by the way, is not just a present value calculation. My last development example, Conrad, that the only business person I think in my lifetime to have won the Nobel Peace Prize is a banker. It's called Muhammad Yunus. He set up a bank in Bangladesh again, called the Grameen Bank, and it lends money to poor women, but it charges them 25% interest. Now, the women could go to the moneylender, but the moneylender will charge them 200% interest. Somehow, Yunus managed to reduce the cost of borrowing by whatever it is, 87%. And he didn't do that by having a better net present value calculation, but by all sorts of other things that I think you need to understand if you're thinking about how do we get an efficient finance industry. But so the flow of assets, I haven't gone into macroeconomics, but risk management, protections, facilitating, and then ownership. Finally, Howard, the critical thing on ownership is that the big chunks of equity are now owned by institutions. That was really my job. And those equities have got extraordinary powers, most particularly in most countries, they appoint the board of directors. And in doing so, have massive influence on the way that capitalism works. And so that is a particular role of the finance industry. it's not as straightforward how you carry that out as it is to say the finance industry is there and massively powerful. But it is possible for the finance industry to have a disproportionately large effect on the way in which capitalism is carried out. So also on ownership and ownership and practice of companies. I don't know if that answers your question. I've been a bit long-winded.
We have a question from Mohammed, who asks, what about from banks in terms of figuring out how much bank provisioning they need to set aside to handle credit loss, and that kind of impact on households who rely hugely on the banking sector for things like mortgages, and then they get hit by inflation.
No, and so you've got. I mean, I suspect you've got two things here. I mean, one is inflation, which is possibly, not always, but possibly exogenous to the system. But the other is on default and how it is that you measure it, and ensuring that we're pricing the loans that are going out so that we don't hit some systemic crisis where people are not able to pay back. And I mean, that was the proximate cause of the global financial crisis, that folk were not able to pay back on as it turned out, very complicated securities that had been made up of hundreds and hundreds of mortgages that undermined the balance sheet of the banks. And then every other bank lost its faith in the previous bank that it was lending to. And then all that inter-financial system lending and borrowing that we talked about, the one that is 6 times the size of the money between the real world and the real world, that can then act your disadvantage, because suddenly the financial system is contracting and it's pulling money back from the real world. And of course, that is what happened in 2008, and the governments bailed the banks out to make sure that it didn't happen at very considerable cost.
On this thing about regulation, Rebecca asked, right now, AI and crypto industries, there's not much by way of regulations. And of course, the financial sector is looking into how to use AI. Do you think that there's going to be a financial crisis ahead because of this lack of regulation in those areas?
Yes and no. I mean, I think right now the crypto industry sits separately from the financial industry. I would, though, Rebecca, be quite concerned that we have really thought through how well regulation is stopping the next meltdown coming. I'll come to AI in just a minute. You can create situations, and we look at some of these just en passant in the class, but you can create rules and regulations where things meet the regulation, so they hit the target, but they miss the point in terms of solvency. That would worry me about both the banks and the secondary banks right now. That might happen again. If you come to AI, I don't know where AI is taking us. If you talk to Alan Yegelinzer, I hope some of you are doing his classes, he's really quite concerned about information in the system, and also false information in the system, and whether that could trigger something that could bring about the sort of problems that we had in 2008. To be honest, I don't know. My concern might be more immediate, which would be, I think there is quite a lot of costly zero-sum activity that takes place within the finance industry. I'm not saying we ban it all. I'm just saying we really ought to be aware of that, and that the more sophisticated information that we get, AI, for example, could be something that encourages more of that. rather than us just sitting back and thinking, look, how is it that we get the savings of the world to be invested in a profitable, sustainable future that can pay back for people's pensions and the other things that they're saving for in the future in a world that we all want to live on.
So, David, how can the finance industry help the world get around things like the demographic challenges through pension savings or climate change?
Yeah.
Bringing the capital to climate change.
Just the demographic stuff. I'm doing a lot of work just now with the British government, but also with other governments. In Britain, we've got a pension system for most people in the private sector that is really just a savings account. When you retire, someone's going to give you a check. How could we turn that into a system that said you save, and even if you live to 100, you won't run out of money, so you'll have an income for life? Now, we don't have that system in Britain, despite having a really sophisticated financial system. Yeah. Boy, is that an interesting thing to be working on. And as it turns out, we could probably be giving people maybe 30% higher pensions if we designed this system well. And that is the biggest savings of the citizenry, is that people are setting aside money for old age. So there's a huge challenge and unanswered, despite all the sophistication of the technical finance. And on climate, I'm just finishing a piece of work chairing a task force for the Scottish government on how is it that you can encourage private capital into a green investment. And we absolutely need to do that, because there isn't enough public capital to do it. And there have been real constraints in doing this, not least on understanding that the finance industry doesn't exist in a bubble, that it exists as it's an ecosystem of its own as part of a larger ecosystem. And we've never done a very good job of linking what is the role of the finance industry and how will the finance industry respond to other signals that are being given by the world. But I could go on to the end of our session on environmental finance. Whoever asked the question is very welcome to send me an email, and I'll send them a longer one back.
Okay. Well, do you have anything more to add to this question from Sebastian on LinkedIn, which is ahead of COP29? What's your thoughts of the role of financial services and its obligations to scale climate and energy transition finance? What are the are there any game-changing policy moves?
So, let me. If I was to look at what we're doing, we've got hundreds of initiatives of things that we're telling the finance industry to do. If I had a plea, it would be, can we think about just some of the really basic things? So one that I'm doing a bit of work in right now is on climate accounting. Should it not be the case that if you're a fossil fuel company and where it's material, when you draw up your balance sheet, that you should consider the climate assumptions that are implicit in the valuation, for example, of your oil wells or your asset retirement obligations. And you should tell people how that's been taken into account. And you should allow society to know whether your trading is sustainable, fundamentally sustainable because you've used appropriate oil prices and volumes and all the rest of it, or it's fundamentally unsustainable. I think that's implicit in the principles of accounting. If you're the insurance industry and you're giving directors and officers insurance which will last for many years, so this is not like household insurance where you can withdraw it if there's a flood. This will last for many years. Are you insuring companies and their directors against things that they are doing which are going to destroy the climate and will be picked up in the courts in 15 years' time if we have a climate crisis? If so, why are you allowing that to happen? Why are you not insisting that we have a code of practice for business that says this is how it is that you are allowed to behave, presumably sustainably, and if you do that, then you'd have safe harbor from a suit. So there's lots of things like that within the financial system that I think we do need to be doing. Actually, I think if we were doing those really purposeful things that were having an impact, that we might do more good than some of the financial products I think that are being brought out, which are kind of nice, they're kind of virtue signally, but I'm not sure they're changing the world very much. And by the way, we need to find vast sums of money that is going to be investing everywhere, but particularly in the global south, in the new technologies for a sustainable world. Does that answer the question, do you think, Conrad?
I think so, yeah. And
And then the
David,
big picture.
yeah. And David, you've also spoken and written a lot about the role of shareholder activists.
Yeah.
Right? Do you see that? What's your thoughts of how shareholder activism can play a part in, again, addressing these huge global issues?
Well, look, Conrad. It just you know, if you're a fund manager, most of the people, first of all, it's likely you're investing on behalf of hundreds of thousands of people, right, through pension funds and so on and so forth, and it's likely that they in turn are investing in thousands of companies. Yeah, you are a universal owner. Yeah, it makes absolutely no sense at all for you to be encouraging people to do things that have got great cost to the overall economy and the overall society, because we're talking about hundreds of thousands of people here, because they can put a couple of extra pence in your pocket in a dividend, because the same people that are getting the couple of pence are the people that are going to have to be paying out the pounds because we allowed companies to behave badly. So the role of the shareholder, the explicit role of the shareholder, is critical in bringing the world to a sustainable place.
So, David, you've been advocating for a greater sense of purpose for many years in the finance industry. What, when you say these things, what do your finance colleagues, what's their response? Do they accept what you're saying, or do they shake their heads, whisper to their PA, please don't invite David again to the party?
No, I think in general, this is what people want to do. You know, people, they can see tantalizingly how profoundly important the finance industry is to our general prosperity, and to all sorts of other issues as well. And they want to promote that. Where it gets more difficult, Conrad, is I'm asking some questions, but I've been working for 10 years now on trying to get income for life pensions re-established in the UK. We're not quite there yet. We're very close, but we're not quite there yet. The first one will launch in the summer for 140,000 people. But it takes a while, and people do want to argue every corner. And I think what I do think is good, though, is that we're beginning to have the argument. And so, for example, even 8 years ago, I chaired the finance initiative for the Paris climate talks, and I remember, and I went to lots of the sort of pre-meetings for Paris. And there's one of the delegates took me aside at Paris, and he said, "When I first saw you, I thought you were really the devil. I wanted to have nothing to do with you. You are an investor, but I can see that what you're saying is that as investors, we need a tough deal done in order to make sure that money will flow to the things that we need flow to. Thank you very much for what you've done." I mean, no one today could have gone to Dubai and said that the investors were behind doing anything else other than trying to secure those sorts of outcomes. So bit by bit, the finance industry is moving, but it's always 2 steps forward, 1 step back, and this is a journey, not a destination. So I think in general people are positive. However, you go in and see a wealthy hedge fund manager and say, "I'm not really sure how purposeful the activity of your business is." Of course, they're going to argue back, but that's okay.
Debasis has a question about consumer and investor protection. So he asks, there are many things that protect consumer interests. You've got FCA. is there enough regulations to protect investors' interests from some of the things that the finance industry gets up to?
I think it can happen on both sides. I wonder about, first of all, how well regulation is protecting people, but I think the FCA and the Consumer Duty is kind of interesting what effect that's likely to have. When the money has gone through 4 or 5 different agents, I wonder as well how they're going to implement the Customer Duty, because it sort of wants to be to the principle of the money. But I mean, you do also discover situations where people who have been loaned money are treated very badly. I mean, that did happen in the financial crisis and in the run-up to the financial crisis. Most famously, it was called the Reading. If you're from the UK, if you're talking about FCA, the Reading branch it was one of the big banks that was essentially using the small print of the loans to make companies bankrupt. So you do need protections on both sides. But let me just say one extra thing about that. Regulation is not the only protection. And indeed, we have a tendency to write more and more and more regulations. So in pensions, for example, when I started in that field, there were 3,000 pages of regulation. Today, there are 160,000 pages of regulation. If we don't have a system where the rules are understood by us as professionals, and we try and write only the regulations for it, we're going to have a problem. Imagine if you went to see your doctor and you said, well, I'm not sure how well your doctor's trained or what they know about anything, and they can do absolutely anything to me that they want to, providing it's within the regulation, and there's 160,000 pages of regulation. That's not the medical system we're wanting. We're wanting a set of professionals who understand how it is that they deliver, and that's both for the borrower and for the lender.
Thank you so much, David, for helping us really reframe what we should expect from and demand from the world of finance. And to the viewers, thank you for your questions. If you like the show, please remember, repost it on your social networks. The balance sheet will be back next week, 8th March, same time. We'll have Vignesh Chandran speaking about how to use customer data to drive strategic change. So till then, stay well and see you next time.